Good afternoon, everyone. What we're talking about is the S&P 500 daily chart. We have given an alert out a few days ago that we're going to have price volatility come back in the markets like we did over here when we called this very top on the S&P at 1687 down to 1560. And we put the bottoms in and we had another great rally to another high where the S&P hit 1710, our target. This is the daily chart and the 10-day simple moving average. It's the beginning of the dog days of August, and the earnings season is starting to wind down. So we are going to be watching for a few things. When we look at a 60-minute level on the S&P, we can see where the rallies come up, but then we are coming right back down here on a 60-minute chart. So the volatility that we see in the S&P right now is still tame and low. It's not a big sell-off, but this is how they start. And we're going into a big change going into September. The market is overbought. The bull needs to shake out the buyers and pull back and set up another base to make another all-time high during the fall season. So what we're instructing and what will happen is that the volatility starts like this at the top, just as it did over here. And we are going to be looking for similar type of, we would say that we would have to have a bigger gap down on an opening bell. The weekly chart, that's just the beginning of the weekly bar here. So we can clearly see from 1560 to this top, we're looking at where the S&P would come down to 1620 now over time. And that we even may have to carry through a part of September to actually hit those levels. The bull is very strong. There's a lot of money on the sideline waiting to find a home in equities. However, when we have these pullbacks, they're going to be viable. And we're looking forward to looking at some of the bear ETFs that would be for a very short-term trade during the pullback, and the volatility will increase on a daily level. So the volume was very light on 8/5. Yesterday was the lowest volume day of the year. So we'll just use our 30 and our 60-minute charts to see how that S&P is not coming back off its lows and just rallying straight up. One thing that we can be mindful of is this VXN that I would like to get up there. Let's see, we have it. It's called the Volatility Index, S&P 500. This is going up today, and it's coming off historically low volumes. So once again, let's visit this on a daily level. The fear indicator. Last time we got down here in that last great market top that we called, we went straight right up to 22. Once that got up and we started coming down, the markets put in their bottom at 1560. Now we're right back here at the lows. It's very complacent. It's something for people to understand that on a weekly level, here's a weekly bar. So when this goes up, the S&P goes down. And here's the weekly S&P distribution. And then here's the VIX on a weekly level. It's just the very opposite. It's the very bottom, we know. So one thing about understanding price volatility and bull runs that we've had is that bull side volatility, meaning that you get some good shakeouts in the market and indexes pull back and they set up again before they make their next bull run. So it's very important to understand how this correction turned into another bull run, and that this next pullback that we are telling everyone that's going to happen. So it's good to take money off of the table up here. There will be a rebalancing act in September. We are in the dog days of August, 8/6 of 2013. And all eyes, ears, and the internet's going to be really jam-packed with information about the FOMC. Are they going to taper back on their bond purchases? That is all the retail stuff. Markets have to have a reason to sell. Great bull runs have to shake out like they did here. They shook out the buyers and bam, we rallied. I'm going to conclude that the S&P will pick up in volatility for the foreseeable, at least over the next, I would say, 3 to 6 weeks.